Welcome traders to MTI's Market Update. This is Kevin Dixon, Senior Trading Analyst at Market Traders Institute. Over the last few weeks, I've been talking to you about the exciting price action and opportunities that are created through earnings season. There are a variety of strategies that you could use, from straddles to strangles to even some day trading opportunities to capitalize on the exotic price movement that occurs during the season. Now today I'm here to talk to you about one of my favorite strategies. It's a very simple strategy. It's easy to do. It's so easy a caveman could do it if they had a good internet connection. It's called fade the gap and fill the gap. Behind me I've got the cues. So I'm going to describe a little bit of the current price action, then I'm going to take you to the meat of today's conversation. The NASDAQ 100 here. Now the last few days we've been consolidating. We're going to break new highs on the NASDAQ 100. My name is not the chief. Wait. My name is still Kevin Dixon. We're going to break highs either way. How about that? Is that good enough for you? Seeing some consolidation here, and that's okay because we're not seeing selling. Now remember, we've been going through a lot here with tariff talk, trade war conversation, and negative connotations to earnings. So yesterday, for example, China carried a 25% tariff on crude oil. 25% on imports of crude oil. Of course, the price of crude oil dropped 3, almost 4%, and that was just a quick knee-jerk reaction. But look, the markets themselves didn't even blink. So if you're worried about the fear that's out there, don't be afraid. There's no need to be afraid. Just getting through the end of the summer months, which summer months tend to be a little bit slower. Before I take you out of the NASDAQ, there's one other stock I want to talk about today. I think it's really setting up good, and it's one of the top stocks in the NASDAQ. So let's talk about Microsoft. Believe it or not, if you followed me for a number of years and you get those Microsoft updates on your computer that take forever, then you're thinking, why do I even like this company? I want to short it, right? That's the revenge trade. But Microsoft getting back above 110, we've got a doji on the day. You see those highs to the left? Here's another reason that you're going to see new all-time highs on the NASDAQ 100. And it's because of stocks like Microsoft providing leadership, even as Amazon sets new all-time highs today. Remember, I told you that this stock is going to go to 2,000 bucks. Today it's above $1,900. Are you a believer yet? Well, how do you capitalize on this? I think you buy some calls out there and get ready to roll up. So now I'm going to take you into our conversation for today. This is in regards to earnings. Now I've got a strategy that I like to use, and I've actually got it drawn up on the board for you. First of all, you've got Roku, Yelp up here at the top. I'm just going to show you the big price action that occurs. Look at this magnificent candlestick on Roku. We will Roku. You can bet on that. And huge, huge moves. This is the type of privilege that you get when you know where to locate the stocks that are moving in the pre-market. Here's another one. Yelp, I need somebody. Yelp, not just anybody. Somebody, Yelp me, Yelp me. Ooh, that's up about 10 bucks, 25% gaining on Yelping. Now let's talk the strategy I've got for you. This is excellent. I've drawn it up and I'm going to explain. This is a strategy that's called fade the gap. So what is fade the gap? What is fill the gap? Well, the first strategy we're going to talk about is fade the gap. Fade the gap is a day trading strategy that's built around a gap. That's why it's called a gap play. And in fading the gap, you'll look and you'll notice on this chart down there that there's a low and then there's your open. So there's your low down below, right down here, and there's your day open right here, okay? So when the day open is above the previous close, this is called a gap up. Now the reason that the gap occurred, of course, is earnings here. It could have been an analyst upgrade. It could have been an analyst downgrade. Could have been Oprah Winfrey. You never know what causes the gap to occur, but quite honestly, you don't care. What matters is price. Like Bob Barker says, the price is right. So this is a price action trade. And the reason that this works, what we're actually looking to do with this strategy is short sell the stock as other traders are taking profits. Because remember, if you're in a long trade, you want to take your profit, you sell to close. When you sell to close, you create selling pressure where a day trader who's clever can hop in and cop out of a short sell, trading with the strength of the profitable trend. Now I've got it drawn up here and I'm going to work out the dynamics for you. What you do is you take the low in the first 3 to 5 minutes. This low in the first 3 to 5 minutes becomes support for the trade. Okay, so as we break the low, you get short at market. I've got $51.54 as the go moment, short at market. Your targeting goals are 1%, so a $55 stock, you're looking to knock out 55 to 60 cents to win the trade. Now the low here for the day was around 48.50. So this offered out about 3 points or 6% within less than 5 minutes. A few of the crew on the opening bell this morning we're able to get out and make some really good coin very quickly. Now again, the market gives you this trade because gaps only happen once a week in Forex, and that's on Sunday when the market opens again from Friday. But the stock market gaps every single day. As long as the price opens above the previous close, it's called a gap up. If the price drops below the previous close, it's called a gap down. So when you see a gap up greater than 4%, minimum 10,000 shares in the pre-market, and on a short sell, I recommend that the average daily volume of the stock be well over 1 million shares a day. Because remember, to short sell a stock, you're borrowing shares from the broker, and if we don't have liquidity, they may not have inventory for you to borrow to open the short sell. But this is a really simple and brilliant strategy. You're going to think, well, I'm going to do this to it. I'm going to add this to it. Don't change the rules. The rules are so simple. Teach your dog to do it. That way you don't have to sit in front of your computer. But this works in the first 30 minutes, the first hour, and then you could be done for the day. Wouldn't that be great if you didn't have to sit in front of your computer all day waiting for something to happen because you knew when it would occur? It's like a crystal ball. Now I'm going to show you Stamps.com. This is another stock we're going to look at here right now. And Stamps.com went the other way. This is a strategy that the stock gapped down. You see we have a close over there where it's up, and then we have our open down here where it's down. So it opened at $220.90. Now again, this is an expensive stock, but this is filling the gap. You let the high in the first 3 to 5 minutes happen. There's your high in the first 3 to 5. You draw your trend line. Now notice how that high became support right over here. This is not a coincidence because this is the way the fill the gap works. Fill the gap is a strategy constructed around the stock gapping down. Now in order for you to take profits as a short seller, how do you get out of the trade? Well, you buy to cover as a short seller. So when you're buying to cover, it creates buying pressure where a day trader can come in, get long at market. That's why it's incredibly important to trade liquid stocks that have a really good trading volume, because if you trade low volume stocks, the spread could come into play even more. But the strategy rules remain the same. And the gap down, let us set a high in the first 3 to 5. We won't do this on anything that's less than $5 because really, there's no point to try and get a 1% on a nickel where the spread could be 3 or 4 cents. That just doesn't make good financial sense when you're looking to facilitate a quick entry. So let's get back into the chart and I'll explain what happened here. Now this is also one we had some folks capture. It gapped down below the 220 mark, but we didn't even think about getting long till 232, and our opportunity maxed out here right around 246, 247 bucks. You know, 16 bucks on a $200 stock in 10 minutes, we're talking 8%. Does that sound good? Now I'm just trying to make 1% the trade. But if you can make 1 to 2% per trade within the first 30 minutes and walk away, would that be a great lesson I've taught you today? I would tell you that when I discovered this strategy, and I wish I could say I invented it because the market makes this strategy, the market invented it. It's just my rules for trading it that are unique. But the gap itself, this is the stock market saying, here, look for this opportunity. Now it is for day traders, so short selling, you need to have a margin account. Doing the fill the gap, you would not necessarily need to have a margin account because again, getting long, generally the market will let you buy there. But if you're short selling, this is for people that do have $25,000, $30,000 or more in their account to be able to borrow from the broker. Now, one other thing I'm going to address, and then I'll let you walk away for the rest of the day, is I would say, I'm going to talk about Tesla. Tesla. Oh, wait, hold on. Tesla. Wait, well, Tesla. It's funny, but it's also sad. Did you see the tears? Okay. Elon Musk goes on Twitter, and I think he's maybe smoking a little bit of that medical marijuana, right? He's putting 420 on everything. And 420 is the price he's talking about taking Tesla private. He spoke about this on Twitter, violating, I don't know how many securities laws. If you're the CEO of a company, you go on Twitter and you say, well, I'm going to take the company private. And it jumps up 40, 50 bucks. It's called blatant stock manipulation, brother. So not only is it a good idea to take the company private, which it is, it's a dumb idea to go on Twitter and explain about it before you actually have a plan together to do it. Subsequently, Tesla got trade halted. Here's the giant move that you had the other day in the chart. It got trade halted while they had to verify this news. So look at this. It opened at 343 bucks. The high is $387. No, you'd already done the earnings. Now, the stock needs to be above $380, $390 for them to pay off some of their debt that they have, some of their bond debt they have coming up. What a coincidence. It trades right up to historical resistance and doesn't go further. The fix is in here. Now, that said, benefits of going private. The benefits of going private will allow you to step around the obligations of being public. The obligations of being public mean that you have to report earnings. You have to tell people how many employees you have. You actually have to make a number of cars. You have to actually hit your numbers on cars delivered. So if you're private, nobody knows what you're doing. They don't know. Really, it's none of their business how many employees you have, nor do they need to know your production numbers. So I feel like Mr. Musk over the last few months has felt pressured to meet production numbers because he said he was going to do it. Now, if you do something, if you tell somebody you're going to do something, you generally want to do it, right? But the benefit of going private for a company like Tesla is very important because they're a very aggressive, growth-oriented company. And I think really going private would allow them to realize some of their greatest potential. The last deal that went private of a company at this price level was TXU Electric a number of years ago. Well, and that story didn't end on such a great note. TXU ended up going bankrupt. But with Tesla, still inventing cars, flying them around the universe, flying them into space, making a boring company, owning Solar City, SpaceX, little rockets and things like that. Very diverse company and certainly a lot of excitement around this industry and field. Now, as far as going private, would that be a good thing for Tesla? Yes. As far as going public and not meeting your car expectations, would that be a good thing for Tesla? No. So if you're going to stay public, be public, act like you're a publicly traded company and meet up your obligations. Otherwise, your investors are going to sell your stock. Doesn't that sound like common sense? Either way, it's going to be a great play if it drops. It's going to be a great play if it pops. Tesla, they make electric cars. So does Mattel. Food for thought for another day. Either way, have a great day. With Market Traders Institute, this is Kevin Dixon. Thanks for tuning in to MTI's Market Update. We will see you next time.